Welcome back to the Retire in BC podcast. I'm Ben Machel, and today we're talking about something that keeps happening over and over again in financial history, but somehow always feels brand new and unique in the moment, and that is a market bubble. We're going to walk through one of the most famous examples ever, which is the Dutch Tulip Mania, and then zoom out and understand what actually creates a bubble and what you can do as an investor to try to avoid being in one when it bursts. So let's get into it. Arnold, do you want to maybe set the stage for that tulip mania that I had referenced?
Sure, let's jump back 400 years to the Netherlands, early 1600s. Actually, no, wait a minute. Let's just jump back 30 years to when I first started in this business. Some of you listening to this podcast may have received a hard copy newsletter that I used to mail out where I actually talked about this very same thing. And um, I'd be very curious if any of you out there have one of those old copies out there. I don't even think I have one of the originals. It'd be interesting to see what I wrote back then. Anyhow, let's jump back 400 years. It's the Netherlands, early 1600s. One of the richest places on the planet. Trade's booming. Ships are coming in from everywhere. People are making serious dough. And in the middle of all this wealth and optimism, something weird starts to happen. This flower, a tulip of all things, just becomes the hottest status symbol in society. They'd been introduced by the Ottoman Empire, unlike anything they'd seen before, so they were kind of unique and cool. Bright colors, cool patterns, flame-like streaks in the petals. They loved it all. And because they were rare, owning one became a sign that you had, quote, made it.
Yeah, and so I mean, it started with people who had made it, right? It started with the wealthy merchants and nobles and things like that. And because owning one was a status symbol, people just wanted to buy them, buy them, buy them. The prices really started to escalate quite quickly. And what happened at that point was other people jump on the train. They see this asset, they see the tulips, that the price just keeps going up and up and up. And so at first it starts with people buying them because they think they look pretty, and then over time devolved into people buying them to resell them, not to own them. Um, and so at that point, like people thinking that they're buying them just to flip a profit, that becomes really iffy and not a good foundation for a market, as we'll see. But in this case, actually, something interesting happened. People were also buying on futures. They started to have futures contracts, meaning people would buy bulbs that hadn't even been grown yet. They were going to be grown next year or the year after, and intending to resell that contract without ever taking possession of it. So kind of like today, some people might buy a pre-built condo. It hasn't even been built yet, but you are allowed to buy and sell that contract. So that's what was happening with these tulips.
So, like Ben said, it wasn't just about collectors, ordinary people, tradesmen, shopkeepers, everybody's getting in on this. And prices, just like every other bubble we've ever seen, prices go up and they go up and they keep going up. And some people are a little bit nervous, and some people think, we've hit the peak, but they keep going up. But one day, all of a sudden, somebody tried to sell and there are no buyers. And that's when the world fell apart, or the market collapsed almost overnight. The entire tulip market unraveled. It happened very, very quickly. And again, that is typical when you hear about bubbles bursting. That's exactly, it's an immediate, it just happens very quick. But the real story here, I think, isn't about flowers, it's about human behavior. And because once you understand what drove tulip mania, you start to see the same patterns everywhere, even today. Most of you have lived through numerous bubbles. We'll talk about some of them as we go on here.
Yeah, well, in that Tulip Mania specifically, like it was a huge crash, which is why I think it garners so much attention. But it's at a certain point, like a single tulip bulb some of the rare and exotic ones, they would sell for as much as a house in Amsterdam at the time. And then it's a little hard to kind of calculate how much they came down by because of the currencies they were using at the time. But it's, after the crash, those prices, they came down to about 1% or 1 to 5% of the peak values of what they were at the beginning. And so all that's based off is like those people who were just buying based on the price going up, now they're selling based on the price going down. And so these, speculative forces can really cause some chaos there.
Well, and it might be hard to figure out what the dollar amount is, but there's some very clear comparisons you can make. There is a great book. It's a bit hard to read because it's old English, but if any of you ever want to borrow a copy, I've got one you can borrow. It's called Extraordinary Popular Delusions and the Madness of Crowds, written back in 1841 when they really knew how to name a book. Extraordinary Popular Delusions and the Madness of Crowds, by a guy named Charles Mackey. And he outlines a series of different bubbles that happened in society over many, many years. But there's a great little line in here about just before the bubble burst here. It is related that at one time, early in 1636, there were only two roots. This is a specific kind of root of the tulip bulb. There were only two roots of this description to be had in all of Holland, and those not of the best. One was in the possession of a dealer in Amsterdam and the other in Haarlem. So anxious were the speculators to obtain them that one person offered the fee simple of 12 acres of building ground for the Haarlem tulip. So, 12 acres in a city, not just like 12 acres
Mm.
out in the middle of nowhere,
And
12
in a
acres in a
bustling
city
city,
for,
in a city
for,
that
yeah,
is quite wealthy and doing very well, hence why all of this is going on. So,
for a
um,
tulip bulb.
yeah, yeah, for a single tulip bulb. And I think obviously this is a very good example of a bubble creating and then collapsing and all of that. I think the reason why I like it is it's just such a clear example of if this can happen with something as simple as a flower, then it's very easy to imagine a bubble forming with something a little bit more not tangible, but something more that obviously has a bit more value in and of itself. And so it's just a really good insight into the human psyche and how collectively market forces can cause this to happen. So on that note, yeah, I wanted to talk a little bit about take a step back from tulips and talk more generally about how a bubble forms, what are some of the signs we're looking at, and all of that. Typically, it does start with obviously some kind of spark. That's not always the case, but usually it's some new good, like the tulips. It's innovation, it's a new opportunity, or sometimes it's just a new narrative. People are looking at this old thing and they're thinking about it in a new way. Um, shift in environment, that
But
that
I,
kind
I
of
it's
stuff.
it's important to point out that it's not a bad thing,
I know, yeah.
right? Tulips are nice things.
Mm-hmm.
Most bubbles start off with something that's positive, you know. So it's the speculation that causes the issue.
Well, yeah, exactly. And it's like at the beginning, this is a good thing. There's interest in it, and because there's interest in it, prices start to rise. Uh, Early adopters or early investors, they do see a lot of gains. They see, the price of this thing that they had goes up, those stories spread of those early wins. And that's when I think for me, it kind of shifts a little bit. At the beginning, you're right, it's not necessarily a bad thing. Maybe there was a lot of justification and fundamentals there. But after some of those stories come out, you start to get into the part of investors having this fear of missing out. More participants are piling in. And they're, it's easy to do that as well. You're looking at this market, you're looking at this thing, you don't know anything about it, but you see people winning, and you're thinking, everyone's making money except for me. Why didn't I jump on that a year ago? What's going on here? I should buy some. And for me, I think that's kind of the part where we shift into being not such a good thing.
Well, and even worse, and we saw this with the tulips, people start borrowing to get into
Mm.
them or using, you mentioned derivatives, futures markets to get into them. They take riskier bets, and that leads them to lose not just their own money, but more than their own money because they borrowed or with a futures contract, you're putting up a small portion to control a bigger amount, and so you can lose more than the amount of money that you put in. That's to me almost the scariest part is when we see people do that kind of thing, um, uh, going all in and risking large amounts. Uh, but anyhow, so yeah, so the speculation takes over. We get this leverage risk taking increase, and then something happens. Um, it can be small, it can be big.
Well, it can be very small. I mean, if we got here based on almost no fundamentals,
Right,
then think
right.
about how much it takes to then burst the confidence, right?
Yeah.
It often can be basically nothing. It's just overnight someone realizes, what am I doing? This doesn't make any sense. And at that
And yeah,
point, yeah, they break the confidence of everyone else. There's no liquidity, and other investors realize they're holding this asset that was totally irrationally priced. They don't actually want it for that much money. They want to get out, and that really causes a flood and a rapid
well, it
decline.
effectively drops to zero overnight or close to it because everybody's running through the doors and in a crowded theater. Yeah, I mean in financial markets we know for every seller there's got to be a buyer. So if nobody's buying, um, then you're not going to be able to sell, you
Yeah,
know.
yeah,
Um,
and I think the reason I wanted to step back just from any specific example in the tulips and things, just realize that a bubble in and of itself, usually it's more a lesson about human behavior and less a lesson about that specific assets. How much are we going to learn about tulips today? Not that much, but it is human behavior that is the same thing that has led to this again and again and again, in different markets.
Well, and yeah, like I said at the beginning here, we've seen it in our lifetime numerous times. I'll talk a little bit later about, the tech bubble. The I think maybe it's worthwhile noting that in my opinion, it's highly unlikely that the broad stock market will be ever get into bubble territory. It was in 1929, but specific niche areas of the stock market or even individual stocks can and will go into bubble territory. The broad stock market's a little bit different because there's so many people now actually valuing, trying to determine what companies are worth, that as a broad category, it's highly unlikely that it would ever enter into any kind of bubble territory. But certainly individual niche areas like the tech bubble that we saw in 2000, um, the railways really is what caused it in 1929. So those areas, they're going to continue to happen, and you don't want to get caught in those, that's for sure.
Yeah, well, and like you say, there have been some in our lifetime. There have been lots throughout recorded history. I think the
Yeah,
Tulip Mania was kind of one of the first recorded cases and one of the really big ones. But I mean, again, we had the South Sea bubble in the 1700s. We had railway mania in the 1800s. We had, to your point, 1929 that caused the Great Depression.
yeah,
That was a bubble that we'll talk about in a minute. We had the dot-com bubble in the 1990s. And that one, even more recent enough that a lot of our listeners will remember that happening, and an internet boom. Any company that had no profit but had a internet domain, getting huge valuations, and then just a huge crash in the early 2000s. Again, just people piling in based off of speculation, not based on the fundamentals of those companies.
yeah. Well, whether it's tulips, railways, dot coms, cryptos, the pattern's surprisingly similar every time. Um, so um, anytime something feels like easy money to you, I would say be exceedingly cautious. I think it was in 1929, the one of the big brokerage houses, the CEO, he was getting his shoes shined, and it was the shoe shine boy that gave him a stock tip. And that for him was the trigger. He said, if it's this easy, if I'm seeing novices think that they really know what's going on. It's time for me to get out. And he actually got out and obviously did very, very well.
Yeah, and I think to put that kind of succinctly, I'd say popularity does not make something a good investment, right?
Right.
Just because so many people are in it doesn't make it good. And just because the price has gone up in the past doesn't make it a good investment. Uh, we've seen it time and time again. Those things can both happen, not based on fundamentals, just based on speculation, and then it can hurt you. The way to protect yourself against this is number one, work on the fundamentals or work with someone who does that instead of just going off of speculation. Two, we've preached it before, but diversification, that's a free lunch, be over a whole bunch of different assets. And that way, if one of them does, burst and go down quite a bit, you're in good shape anyway. And then, just recognize that long-term planning beats short-term speculation.
Well, and I think I'd want to add one other thing. The sometimes if you're speculating, you're going to win. But
Hmm.
just because you lived running across a freeway doesn't mean it was a good idea. So, sometimes you're going to win, but you got to recognize that when there's that kind of speculation, you can also lose big, and it's probably not a good idea.
Yeah, well, and generally speaking, by the time you are hearing about it, like in the shoe shining example, by the time you hear, hey, this thing is awesome, it keeps going up in value, everyone around you is talking about this investment, you're probably late to the party.
Yeah, yeah,
And again, it can keep going up. It's totally possible for that to happen. But I personally would not just jump in on it based on everybody else jumping in on it.
yeah, yeah. And if you're tempted to, make it a tiny, tiny, tiny portion that you're willing to
Mhm.
lose, not the core of your portfolio.
Yeah. Now, most of those we've talked about so far, they've been fairly isolated examples. The bubble has occurred in this one market like tulips and then burst. It didn't really, in that case, go on too much to disrupt the rest of the economy. Sometimes it can, and I know, yeah, you had already referenced the 1929 bubble. Yeah, do you want to chat a bit more
Yeah,
about
yeah,
that?
so I referenced this book last time, Stocks for the Long Run. Jeremy Siegel went back 200 years, tracked stocks. 1929, um, what we saw was a time period where investors there wasn't a framework for people to determine what companies were worth back then. And what we ended up happening was on a broad market basis, people were buying companies just because they were going up, not because they were good value. And so without any reference to what's it worth, well, prices are going to go up and up and up until there's a bubble. And I think actually that also is a bit of um, another indicator sometimes of when something's in a bubble is it's more likely to happen with an asset that there is no real way to value it. What's a tulip worth? What's an ounce of gold worth? There's no unless you're comparing it to other things. Um, of similar like value, there's no real way to value it. Whereas if you've got a company that's earning X number of dollars, well, you can take a look at, well, how long is it going to take me to get my money back if I invest in that company? You can come up with a valuation. So bubbles have a tendency to happen in those areas. They're not always, but they do tend to happen. So 1929, we saw this lack of valuations and the broad stock market got into bubble territory. Since that time period, after that happened, it's stock prices have been high, broadly speaking, but they've never been in what we would call bubble territory. And I don't think they ever will, at least not in the broad market. We did see it happen in the niche market of the tech bubble in 2000. Um, And again, in both of those situations, they were caused by speculation, not by fundamentals. When you have sound valuation decisions happening, that's what keeps bubbles in check.
Yeah. Well, and I think that's a really good point about just kind of the valuation of things. I think with stocks in particular, it's like there are so many different ways to value them. Most commonly, you're doing it based off of the cash flow, and to your point, it's just a fairly, I mean, again, different ways to do it, but at its base, the core of it's pretty simple. You're just taking the cash flow of the company and you're saying, how long, based on this price, am I going to take to break even? And is that worth it to me based on the ups and downs, based on the volatility we see? Same thing with land, something like that. Even if it's your house and you're not getting cash flow from it, you can do this relative valuation. You can say, if I did rent it out, how much would I get for it? Do that analysis, come up with some kind of valuation, other than just, whether or not other people are wanting to buy it or price speculation and things like that. So, and yeah, bubbles, usually they're occurring in more niche markets, more, small pieces that are harder. They don't yet have this big, robust system behind them of valuation. I did want to touch on, because, I mean, oftentimes you hear kind of, and you touched on it there, stocks are at an all-time high. The prices are very high right now. Are we in a bubble? The reality is stock markets are all at all-time highs quite frequently. On average, like 15 or 20 times per year, we'll hit all-time highs in the stock market. That's not an indication of being in a bubble, not necessarily. If it's justified by the fundamentals, if they've had good earnings, if interest rates are lower, a whole bunch of other factors there.
Well, companies make more money, so their
Yeah,
share prices go up.
yeah,
It's
exactly.
fairly simple. Yeah, no, absolutely. So, um, yeah. So again, as I said, the bubbles nowadays usually occur in niche markets. And so one of the interesting things is while markets evolve, human behavior doesn't actually change all that much. So, uh, whether it's from the tulips in the 1600s to the internet boom in the 1990s, we see the same patterns play out again and again, over and over. So, for anyone interested in investing for the long term, especially for retirement, the goal shouldn't be to catch every trend. It should be to stay disciplined, avoid getting swept up in the hype, invest prudently for the long run in great companies, rather than going for those big swings that might cost it all. We'll talk more about bubbles in the next episode, give you a little bit more detail. But for now, thanks for listening to the Retire in BC podcast. If you found this helpful, share it with someone who might enjoy it, and we'll see you next time.
Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.